All right, let's break down Sabre Corporation's latest earnings call. This one was a big deal, and the market's reaction? Well, it was pretty brutal. What we're seeing is a real credibility gap opening up between what the company is saying and the numbers they're actually putting up. So here's how we're going to tackle this. We'll start with the headline numbers, then deconstruct the quarter, look at why guidance got a serious haircut, pit their strategy against their execution, and then we'll wrap it up with our take on what comes next. First up, the headline numbers. And really, the market's reaction tells you everything you need to know. It was immediate, it was sharp, and it was all about a split decision between revenue and earnings.
So, on the one hand, you've got revenue coming in at about $715 million, which actually beat the street's estimates. That's a check in the plus column. But, and this is a big but, on the other hand, they reported an adjusted loss of a penny per share. Now, Wall Street was expecting a profit, so that's a huge miss. And you know what? In this kind of market, that bottom line number is pretty much all that matters.
And boom, there's the market's verdict, plain and simple. The stock got hammered, dropping as much as 10% during the day. It's like investors just looked right past that revenue beat and zeroed in on the earnings miss because that's what got them worried about the future.
Okay, so let's dig a little deeper and really deconstruct this quarter. Because honestly, it's a story of some good, some bad, and some pretty ugly stuff.
Now, to be fair, it wasn't all bad news. Let's give credit where it's due. The company made some real progress. They sold off an asset and used the cash to pay down a whopping $825 million in debt. That's huge for strengthening the balance sheet. On top of that, adjusted EBITDA was up 23% from last year, and they managed to expand their margins. These are genuinely good things, solid moves.
But here's where things start to go off the rails. The bad and the ugly? It's all about cash flow. Just look at this. They were guiding for $40 to $50 million in free cash flow. What did they deliver? $13 million. 13. That's not just a miss, that is a massive shortfall. And for investors, that's a huge red flag waving right in your face.
And that free cash flow disaster? Well, it was just the appetizer. The main course was what they did to their full-year guidance. And let's just say it wasn't a trim, it was a full-on haircut.
I mean, just look at this table. It really lays it all out. They went from expecting some revenue growth to basically flat for the year. Adjusted EBITDA, yeah, they walked that back to the bottom of their old range. But the real gut punch, the absolute killer, was free cash flow. They took an axe to it, slashed it by about 40%, going from over $100 million down to around $70 million. That screams that something's not right operationally. So, what did management have to say for themselves? Well, they gave a few reasons. They talked about timing issues with payments, money moving between quarters. They mentioned higher than expected spending. And then they pointed to the U.S. government shutdown, which apparently hit their government and military travel business pretty hard.
And this really gets us to the heart of the problem for Sabre right now. It's this growing disconnect between their strategy, the story they're telling, and their actual execution, the results they're delivering.
Look, the story they're pitching is a good one. It's all about the future. It's about innovation, AI, transforming travel. You heard the CEO. They're talking up all these cool new AI-powered tools, SabreMosaic, agentic APIs, and it all sounds fantastic. This is the forward-looking growth story that they want investors to buy into.
But here's the thing. The market doesn't trade on stories, it trades on cold, hard numbers. And the numbers today, well, they tell a very different story. You've got the massive cash flow miss, that brutal guidance cut, the earnings miss. It all points to major execution gaps. And when that happens, that beautiful long-term story starts to lose its shine. It creates a credibility problem, plain and simple.
So where do we go from here? What does this all mean for the next quarter? We've crunched the numbers, we've listened to the call, and here's our take.
Honestly, it all comes down to the fourth quarter. This is the litmus test. Think about it. To hit that new $70 million target for the year, they need to pull a rabbit out of a hat and generate a staggering $130 million in free cash flow in Q4 alone. $130 million! If they don't hit that number or get incredibly close, trust is just gone. It's non-negotiable at this point.
And that leads us to our rating. We're putting an underperform on the stock. Yes, paying down that debt is great, we love to see it, but the operational stumbles and that huge guidance cut just introduce way too much risk and uncertainty right now. The pressure is on, the ball is completely in their court to prove they can actually do what they say they're going to do.
Okay, let's talk a quick trade idea. We're going to look at volatility. You know how this works. Before earnings, nobody knows what's going to happen, so implied volatility, or IV, goes through the roof. Then the numbers come out, the uncertainty disappears, and poof,
the IV gets crushed. Sabre is a perfect example. We saw IV up over 110% before the call, and then it just collapsed right back down into the 70s afterward. Classic IV crush. So the trade idea, and let me be clear, this is a high-risk play, is to bet on that pattern repeating. The idea is that IV is going to spike again right before the next earnings call. So you could sell that volatility, something like a short straddle a few days before the announcement. The goal isn't to bet on which way the stock goes, but to profit from that premium vanishing when the IV inevitably crushes again right after the news drops.
This is not financial advice.